Welcome to the Deep Dive, the place where we turn complex earnings calls into crystal clear insights.
And today we are taking a very close look at the U.S. grocery giant, Kroger Co. and their Q3 2025 earnings call.
The results hit the wires ahead of the market open on December 4th, and this was anything but a standard quarter.
Not at all. I mean, this call was really dominated by two huge things.
Right. First, you had this painful multi-billion-dollar admission that their main e-commerce strategy was, well, flawed.
And second, you have this inescapable pressure from a consumer who is getting more and more cautious with their spending.
So our mission for you today is to move beyond those headlines.
Exactly. We need to explain the sheer scale of this financial restructuring and the pretty aggressive strategic pivot that came with the numbers.
And crucially, we're going to analyze that disconnect, the gulf between the positive things management was saying and how the market reacted, which was not so positive.
Highly skeptical is probably the right word.
Okay, let's unpack this with the top line results. To understand this quarter, you have to immediately separate the accounting reality from the operational reality.
You really do. They're two completely different stories.
Let's start with the accounting reality. The GAAP numbers were just brutal.
Oh, they were. The company reported a net loss resulting in negative $2.02 per share.
And that massive drop was really caused by one single event.
One event. A gargantuan $2.6 billion impairment charge.
All tied to writing down their automated fulfillment network assets.
Right. And to put that in perspective for you, that single non-cash charge wiped out roughly $3 per share in earnings. It's just a huge number.
So that impairment is really the central story. But if you strip that massive one-time charge away,
the operational picture looks quite different. The adjusted or non-GAAP EPS came in at $1.05 per share.
And that was actually a beat.
A slight beat, yeah. It was ahead of the 103 consensus estimate, and it represented a solid 7% increase compared to last year.
So a profitable underlying business, but it was just buried under this historical failure.
Pretty much. Now, let's look at revenue, because this is where the market started to get nervous.
Total revenue was $33.9 billion.
And that was a clear miss against the $34.3 billion consensus.
Revenue was up 1% year over year. But the devil was really in the details, wasn't it?
It always is. And what truly signaled caution were the core performance indicators driving that miss.
Same-store sales.
Exactly. Identical sales excluding fuel, what most people call same-store sales, grew only 2.6%.
And that missed the 2.91% estimate?
Yeah, and for a major grocer, identical sales growth is the heartbeat of the business. That slight miss is a direct indicator of, softer consumer traffic.
So the investment community just latched onto that.
Immediately. Despite management beating on the bottom line and, trying to keep a positive tone, the stock fell sharply.
Investors were focusing more on the sales weakness and the structural risks that were confirmed by that huge impairment.
Right. So let's dive deep into that structural cost, the $2.6 billion elephant in the room.
This wasn't just accounting noise. This was the definitive outcome of a deep strategic review of their automated fulfillment network.
The whole Ocado partnership.
This marks what they're calling the big reset. Kroger made the very difficult decision to pivot away from that capital-intensive, centralized model.
They're taking the pain, that $2.6 billion charge, and significantly, they're closing 3 of the 8 fulfillment centers.
Just pulling the plug?
Yeah, think about the sheer scale of that admission. They're shutting down massive, expensive, high-tech facilities that were supposed to be the crown jewels of their digital future.
So the new focus is now entirely on a hybrid model.
A hybrid model, exactly. This shifts fulfillment away from that slow, centralized automation, and it leverages 2 things.
Their stores.
Their immense existing store footprint for order pickup, yes, and expanding partnerships with third-party delivery providers.
I'm talking about Instacart, DoorDash, Uber Eats.
All of them. Leveraging the infrastructure and the speed they already offer.
Why is this so much better than their own high-tech centers?
It's all about speed and being capital light. The market wants rapid delivery, orders in 1 to 2 hours. Those centralized centers, they take years to build and launch, and they require so much upfront capital. The hybrid model gives them delivery immediacy, sometimes in 30 minutes, and it just slashes their own capital spending.
Okay, so what's the financial payoff for swallowing this $2.6 billion pill? It has to be big.
It has to be, and the goals are ambitious. Management expects this reset to deliver about $400 million in e-commerce profitability improvements in 2026.
$400 million.
And the explicit target is for the entire e-commerce division to become profitable next year, driven entirely by this new capital light structure.
What's fascinating here is that the e-commerce sales themselves are actually booming.
They are. Sales grew 17% year over year. That's the sixth straight quarter of double-digit growth.
And that's all driven by immediacy.
Mostly, yeah. Orders for delivery within 2 hours grew by over 30%. In fact, their new relationship with DoorDash alone fulfilled 1 million orders in its very first month.
1 million. That just proves the market wants convenience now.
It does. It kind of proves that the slower, high-capital automation centers were just a mismatch for today's market.
Okay, so the e-commerce costs were brutal. But let's pivot back to the core stores. That 105 adjusted EPS beat didn't just happen by accident.
No, the strength came directly from their operational rigor. Adjusted FIFO operating profit grew to over $1 billion, up nicely year over year.
And the gross margin improved too.
Right. The FIFO gross margin rate, excluding fuel, improved by 49 basis points to 22.8%.
Let's quickly clarify that term, FIFO, for our listeners.
Absolutely. So FIFO stands for first in, first out. It basically measures profit based on current product replacement costs. When they say that margin rate improved, it means the underlying profitability of what they're selling got significantly better.
And what drove that?
It boils down to efficiency and private label power.
Yeah.
So lower supply chain costs, lower shrink, and just incredibly strong performance in our brand's private label.
Right, so when a shopper buys Kroger's store brand chips instead of a national brand.
Kroger makes significantly more profit, and shoppers are doing that aggressively right now because they're looking for value.
Which perfectly leads us to the consumer headwinds. Management cited clear financial pressure on, low and middle income consumers.
And it's deep enough that it's changing behavior. They noted consumers are making smaller, more frequent trips.
The sign of cash flow management.
It often is, yeah. And they're trading down. The stress was acutely visible when they mentioned the brief lapse in SNAP benefits in early November. That temporary cutoff immediately hit their sales.
So how is Kroger fighting back against this frugal shopper while still protecting those margins?
It's a two-pronged attack. First, they are reinforcing value by cutting prices on about 3,500 items.
Okay.
And second, they're actively pushing customers toward that higher margin, our brands segment. They can afford to do this because they've found efficiencies elsewhere, like closing those fulfillment centers.
This brings us right to their guidance for the full year. And this is where we see a bit of a contradiction.
We do.
They trimmed their identical sales outlook, narrowing it to a range of 2.8 to 3%, which reinforces the sales weakness.
All right.
But at the same time, they raised the low end of their adjusted EPS guidance to 475 to 480.
And that is the classic playbook for a well-managed business in a slowdown.
Trim sales, raise earnings.
Exactly. It signals that management is confident their cost savings, the e-commerce reset, and critically, their share buybacks can offset that sluggish volume.
They can still hit mid-single-digit earnings growth.
That's the goal. And they even seem to have future headwinds neutralized. Take the Inflation Reduction Act.
Right, that reduces some Medicare drug prices.
It does, and it will technically lower their Q4 identical sales by 30 to 40 basis points. But here's the key.
It's an accounting thing.
It's an accounting thing. Manufacturers will fully reimburse Kroger for the difference through rebates, so it has zero impact on earnings. It's a headwind on paper, not on profit.
That is a very important clarification. So, moving to the tailwinds, the capital returns look impressive.
They are significant. The company completed a huge $5 billion accelerated share repurchase, or ASR, during the quarter.
Wow.
And is now executing the remaining $2.5 billion open market buyback. Plus, their debt ratio is very low at 1.73 times.
Which gives them a lot of dry powder.
A ton of dry powder for acquisitions, or more likely, just continued aggressive buybacks.
And beyond the financials, they're also focusing on long-term growth. New stores.
They're accelerating it. planning to break ground on 14 new stores in Q4 and expecting to increase new store builds by 30% next year.
They specifically mentioned expanding the Harris Teeter banner into Jacksonville.
That's part of their adjacent market strategy to gain share, and the final piece of this long-term puzzle is leadership.
A new CEO is coming.
Yes, the board confirmed the search is progressing, and they expect to appoint an external CEO during the first quarter of 2026.
And they want someone from the outside.
Specifically, they're seeking expertise in retail transformation and operating at scale. This signals that real change is coming from the very top.
Okay, this raises the critical question. If management delivered a beat on adjusted earnings, expanded margins, and confirmed huge capital returns, why did the stock still fall 5 to 6% on like 4 times the normal trading volume?
That is the ultimate perception chasm, isn't it? Management is using phrases like another quarter of strong results.
But the market was laser focused on 3 negative things.
Exactly. The top-line revenue miss, the slightly narrowed sales outlook, and the profound structural risk confirmed by that massive fulfillment charge.
And we saw this pessimism in the options market too.
We did. There was unusual options flow, specifically heavy put volume, about 5 times what was expected.
So short-term traders betting on more downside.
Highly skeptical or defensive positioning for sure. Investors are clearly valuing that structural failure and consumer weakness over the operational profit beat.
And if we put Kroger in the broader sector context, it starts to make a bit more sense.
It does. Over the past year, Kroger has really lagged the S&P 500. And while they've recently outperformed the struggling consumer staples sector, this sales softness just reinforces the general struggle of staples in a market that wants growth.
So the central story is clear.
Yeah.
Kroger is transitioning from a merger-driven model to a standalone, efficiency-driven grocer.
Right. They took the pain of that huge write-off to pivot to a capital-light e-commerce strategy, betting that third-party partnerships are the key to restoring performance.
All right, this brings us to our favorite segment, the This Is Not Financial Advice segment.
My favorite.
We've established a clear conflict here. The market is obsessed with short-term consumer weakness, but management is pointing toward a confirmed, massive $400 million profitability uplift in 2026.
It's a classic time horizon mismatch, which could be leading to a mispricing. The current stock price is based on fear of Q4 sales.
Well, there's this huge confirmed structural profit catalyst just over the horizon.
Exactly.
So what's the outrageous but plausible trade idea that leverages this short-term pain versus the long-term gain?
So the idea is a kind of synthetic long position that finances itself. We would recommend selling short-dated, out-of-the-money put options on Kroger.
Okay, so you collect premium on that.
You collect that premium, leveraging that elevated implied volatility and the bearish flow we just talked about. And that premium you collected then funds the second part of the trade.
Which is?
Buying a deep, long-dated call spread that expires in late 2026 or even 2027.
So you're actively betting against the short-term bears to pay for your long-term optimism on the restructuring.
That's it, exactly. The market is pricing in maximum pessimism right now. This trade acknowledges that short-term fear by selling the puts, but it makes a highly focused bet that the announced $400 million e-commerce profit uplift in 2026 is a structural game changer the market has just ignored.
And once that profit actually hits the bottom line,
the stock should be significantly undervalued at today's prices.
that requires some serious conviction and patience.
It does.
So to wrap up, the Q3 call confirmed Kroger is taking its medicine, that painful $2.6 billion impairment, to set up what they hope is a profitable, capital-light e-commerce future.
But that near-term consumer anxiety and sales softness completely overshadowed the positive earnings guidance and the impressive margin expansion.
So the question you have to ask yourself, looking ahead, is this.
With a new external CEO expected in Q1 2026 and the heavy lifting of the e-commerce reset largely done, can the company execute its efficiency and price investment plans fast enough?
Can they successfully close that persistent performance gap, not just with their grocery peers, but with the broader equity market, before investor patience finally runs out?
That's the story to watch.
It is. Thank you for joining us for this deep dive into the Kroger earnings call. We encourage you to review the details and form your own thesis. We'll talk to you next time.